Reality radio for a really great future. We're talking real money.
Welcome to Talking Real Money, the podcast and the video cast, because I hate the term vlog. I do. I hate the term vlog so much. It's not a vlog. This is a podcast with moving images. See? Images moving.
Sharks.
I'm Don McDonald in Florida. This is Florida. This is what Florida looks like in the summer. For almost every Floridian, this is what Florida looks like in the summer. You know how it is in the cold climates where it snows a lot? And this is what your life looks like in the winter? Well, this is what our life looks like in the summer. I was looking at next week, because I've got sort of an event in my life coming up next week. Trying to discourage my wife from doing anything outdoors for this event when I know, when I just wanted to make sure we were going to be all right, and we're not, because the high next week, 99 degrees. And when you factor in the humidity, today it's only 95, and you factor in the humidity, it feels like
what?
105 today. So you can imagine what 99 will feel like. It will feel like Arizona underwater.
And by the way, hi, I'm Tom. And
did I forget to tell people your name?
Seattle.
I was going to get to that. Tom is in Seattle in the Museum of Military Models.
And I was going to point out, since we're going to talk about the weather, that I just looked at the 10-day forecast. We do not have one day where the temperature will exceed 70 degrees.
What a difference.
Come on. I've got these, my little strawberries are sitting out there like, we're very green right now, but we just like a little bit of sun will turn red for you if you'd like, but I don't think it's going to happen. My tomatoes, same way. I just
stand out there all day with a high-powered LED flashlight.
I think what you're going to have to do.
Here, drink up some light, you little guys.
It's made me very grumpy. I'll put it that way.
And here the strawberries are the size of human heads. They're just
it's like, just a little sun, sir, would be very helpful. But no,
we're like one of the strawberry growing capitals of the country here, Central Florida.
Oh,
they have the big strawberry festival every year. Huge strawberry growing.
Well, okay. Well,
they're not good strawberries, but there's a lot of them.
Okay,
they're really not very tasty. Anyway, we're here to talk about something other than strawberries and weather. We're here to talk about money, something you need, something you want, something you must have in your life, something that makes you crazy and confuses the heck out of you. And we're here to talk about one of the most important aspects of dealing with money and investing, and that is the concept of risk. Risk is confusing and yet incredibly simple. It's so simple. And you generally are doing it all wrong when it comes to dealing with it because you don't understand it. So we're going to help you figure this out and get risk under control so that you can now invest and go, I'm okay. I get it. I'm not down 35% because I get it. Here's a question for you, Tom.
Yes.
And I know you asked this at a meeting, but this is a question for everybody out there. Are you personally in a bear market? Is your market a bear market?
No, because there's still lunch meat out there for me to make a sandwich, so I'm not shy on lunch meat. I'm okay.
No, for example, I looked at my portfolio, which is 35% bonds, I think 65% stocks, roughly.
Well, and I think that's a good idea.
Plus, I'm globally diversified, massively globally diversified. And I think through this bear market that I'm down about 13%, 12%. No, it's less. More like 10.
And as you know, my portfolio is 80% in a globally diversified equity portfolio, 20% in bonds. Which tells you a lot that who has more money that he can afford to lose. Well, it's not just
it is.
Okay,
trust me.
There's that. I'm more optimistic about the future than you are. That's what I think it reflects.
No, I don't.
People that invest in stocks have to be optimistic. You have to think that tomorrow is going to be a good day. And I'm teasing Don a little bit.
No,
but,
I might be retiring soon. That's why.
Well, that's true. Yeah. Well, when you talk about that off the air. But that's a whole other thing.
Darn it.
The reality
fun,
is I don't look at my portfolio as like the let's go back, because if we're going to talk about investing, people believe, most people, if you ask them what investing is, they think, number one, it's a zero-sum game.
Right.
That somebody wins, somebody loses. That's, hey, I was the loser there, and I don't want to be the loser again. That's number one. Number two is they truly, based on that, they think that to be a successful investor, you have to predict what's going to happen, and you have to trade with that in mind. In other words, you needed to know that the Federal Reserve this week was going to raise rates by, instead of 0.5%, 0.75%. You needed to know that in advance. And then you would have traded, as we're learning now, hedge funds have been selling stocks and selling bonds, et cetera. You would have traded with that in mind. Most people think that's what investing is. Therefore, when you think that way, then it feels riskier, right? Because I missed out on that trade. Don took advantage of me. He made all the money. I didn't make anything on that.
Well, because it feels like gambling. You see that?
Yeah,
exactly. Feels like gambling, which is, most people confuse investing and gambling.
I agree.
Investing should not feel like gambling, yet it does.
And let's talk about what risk is. Yeah, let's talk about what risk is. Number one, risk in investing should not be viewed as a complete loss, as a zero-sum gain. In other words, you're not buying something and hoping it doesn't go out of business unless it's an individual stock, which happens. That's a way to manage your risk, is you never hold all the traditional eggs in one basket aspect. When you do, then you do face complete loss. Otherwise, you do not. Well, okay.
Which is why we say over and over again, people go, really? You don't think we should buy individual stocks? No, because it changes the tenor of risk. It turns it from what we're going to explain it is shortly into this zero-sum gambling process. When you buy a stock, you are gambling because you can lose everything.
And by the way, risk, so let's talk about some definitions of risk. Risk is defined, by the way, as an outcome different than what's expected, including, for some, losing everything. I mean, that is a definition of risk. The reality is what Don just said, that is gambling, number one. And number two, with that definition, outcome that's different than expected, that's a short-term view. In other words, if you pull back and you look at stock markets over the last almost 100 years now, going back to 1926, they kind of generally go up. When you squint your eyes, it looks like it's always going up, and you look closer and you realize, no, it doesn't go up every day. It barely goes. The percentages are like 51% up days, 49% down. Even when you get to months, though, it's 75% of months are up, 25% are down. But when you view risk as what I just explained, as an outcome that's different than what's expected, because you do start to believe that markets are certain. Oh, I always make money in stocks. No, they're not doing that. That's where the trouble, I think, starts for many, many people who are investors, Don, and that leads to some real problems.
But the fact is, had you remained invested over decades, any period of decades, by the way, in the United States, you would have made money just staying invested. You didn't have to do anything, which is why I say risk really needs to be thought of as not the chance I'm going to lose everything. As you said, an asteroid, you could lose everything, but we'll all lose everything, so it won't matter. We want to turn it from thinking of it as the potential to lose everything, my life is going to be ruined, into thinking of it as just degrees of volatility, the bouncing. If you do this right, the only risk you face is, as an investor, is the bouncing. So now all we have to do is figure out a way to manage the degree of bounciness. In other words, manage the volatility.
And this year's been a little unusual because generally, over the long haul, the way to manage that is the mix between the riskier things like stocks and the less risky things like bonds. Now, this has been a strain. I just looked at the intermediate term bond fund that I'm familiar with, operated by Dimensional Funds. Due to these pretty big hikes in interest rates, the price of the bonds has come down. The intermediate term government bond fund is down over 12% year to date. Been pretty tough. So, but generally, bonds are sort of the ballast and stocks are the thing that are giving you the lift, generally. So when we, for example, and I know you're going to get into this, Don, we offer people a free RisQuiz where you can go take a quiz to help understand yourself emotionally, because this is all emotional. Because if you were not unemotional, you'd put it all in stocks, because stocks have made more of the long haul. In 30 years, you might say, why did I own those bonds? They didn't make half as much as that's right. But you didn't want to live with a decrease in the value of your portfolio by 50% like you faced in 2008. So the RisQuiz is a way for you to understand yourselves around the emotion of financial markets per se. That's where the problem, we know the behavioral finance part of this is way bigger than you want to admit.
And before we dig into the RisQuiz, because we want to talk to you a little bit about how you read it, how you read your score. But before we get into that, in addition to the stock-bond balance that has worked in many periods in the past, there is also a degree of non-correlation, not exactly the perfect definition, of other asset classes not moving in lockstep with each other over longer periods of time. Yes, in short periods like this, everything tends to move similarly, and this time it's even bonds. However, bonds have not gone down as much, and the shorter term ones not as much, but there are other asset classes that have done really well, reasonably well, and not even gone down, like small cap value stocks. Some of those have performed quite well. So you want this diversification across the board. You really do. Now, as far as the RisQuiz goes, this is something that was created by multiple academics at a number of universities, and they looked at common thinking traits among groups of people, how certain people think, and then how that affects their ability to remain invested in good times, bad times, up times, down times. And they've come up with a score. And you can take this. You just go to talkingrealmoney.com or vestory.com, and you click on the RisQuiz. And then that will take you. As a matter of fact, I'm going to go to that.
You're actually going to do this right now on the program?
I am.
Are you using the regular version or the electrode one? I think the electrode one is far more accurate. The
FDA banned the electrode one.
Oh, God, no fun of any kind.
Because you kept burning people because you're having too much fun.
How do you feel now? Not as well. So market lost another 20%.
I had it right here, and then the page changed on me first. There it is. Vestory RisQuiz, RisQuiz. Now, this is a really, really simple process. And let me tell you, it is absolutely free.
And there's no obligation.
This is free.
No, you don't.
So what you do is I'm going to go in and I'm going to tell it my name.
Yep.
Nobody's going to
my name.
Nobody's going to try and sell you anything. I'm going to then I'm going to give it some information on how old I am, because that factors into this.
Mm-hmm.
And so I'm going to tell it how old I am. I'm going to tell it
your new age as of next Friday, or your current age.
I just give it my birth date. It doesn't ask for my age.
All right.
So, and then I'm going to tell it how much I have to invest and how much. Now, what it's asking now is saying how do you invest right now? So I'm going to say, about between 50 and 75% in stocks. Okay, that's me.
Okay, yeah, fair enough.
And it takes me to the quiz. Now, in this quiz, you answer the following questions. I'm going to give you some of the questions.
Okay.
I understand financial and investment terms without difficulty. Now, for me, having been in this business for, 40 years, I pretty much strongly agree.
Yeah.
Now, that's probably not most of you. So be honest. I am comfortable with financial risk. This is a great question for right now. Why is it a great question for right now, Tom?
Well, because we know when times are good, when stocks are in periods of rising that you all feel very comfortable. It's a fascinating thing, and you're willing to say, "Yeah, I'm good with volatility. I'm okay with this and this and this." But then when you actually experience it, like we have here this year in 2022, guess what? Your level of acceptance of said volatility is less than it was last year. It's a fascinating thing. And by the way, it's another reason for even people that took a RisQuiz last year, take another one now. Compare your scores, because I think you'll find it fascinating to see how you may have changed emotionally over the last year. Almost guarantee you have.
The next question is, in 2008, the stock market dropped approximately 37%. That meant, and this is the broad global stock market.
Because the S&P lost over 50. Yeah.
Right. That meant that 100,000 invested in U.S. stocks at the beginning of the period was worth 63,000 at the end of 2008. What would you do in a similar scenario now? Would you sell everything? Would you decrease it? Would you buy? Or see, so I'm going to say I would significantly increase my investments because that's what I would do. So, but answer it honestly.
You would increase your exposure to stocks?
In a period, I would put more money into the stock market if it's down.
You would add to your holding. Okay. So if you have
I absolutely
cash, you would. Be buyer. Yeah.
Okay, the next is a chart that shows, in fact, I'll show you this on your screen.
Okay.
Here's a chart that shows the average annual returns of various portfolios from 1950 to 2016. And this is just for an example, and it shows you what the returns had been and what the worst year had been. And this is an opportunity for you to look at this and go, oh, could I have stood a 37% decline in a year?
Pretty steep.
So now you answer it based on this. And so I'm going to click that one. I'm going to say, yeah, I can handle that.
You could handle the 37%?
No, I went down one notch. I would describe my past financial decisions as conservative. I'm going to disagree.
Yeah, I don't think
I feel anxious about my investments performing negatively. I'm going to disagree, but the gentleman who called us yesterday, he's definitely an agree guy.
Oh, yeah, definitely. Absolutely.
Answer these positively. I want to minimize short-term volatility. Again, there's question after question. In the event of emergency, I want to sell some of my assets within a few days. This means you don't have an emergency fund.
Right.
You need to have an emergency fund. If this is the case, you should have an emergency fund.
I concur.
Moving on to question 9. I'm willing to invest in assets with a limited track record in search of higher returns. Wow. That's saying you're a risk taker.
Yep.
That's one I'm going to say, yeah, limited track record? Probably not. Not for me.
Can you say Bitcoin?
I want track records.
Sure, yeah.
When I think of the word risk, I associate it with opportunity. You see how this question gets to the meat of how you think? When I think of the word risk, I associate it with opportunity. You see, I go, yeah. Risk and opportunity go together.
Okay, in fairness, you're a guy who's owned a few small businesses. There is no, to me, greater risk than that. Really.
No.
Your capital is exposed to 100,000 things that could go wrong, and how many small businesses even make it after, 5 or 10 years? It's a very small number.
Yeah, but we've taken, both of us, we've done it.
We've done it.
And
sometimes well, sometimes not
did.
well. Yeah.
Sometimes not. Yeah,
exactly.
I consider myself an experienced stock market investor. Now, tell the truth on this one. I'm telling the truth with my strongly agree.
Okay, so what did that... So could you say that
means I've been in this business a long time and I understand
Okay, but let me ask you another one. Like my daughter, who is in her mid-30s, would you say she's an experienced stock market investor? Been around this her whole life? But I'd say no. Yeah, I agree.
Nope.
No.
She hasn't done it. You actually have to see experience. The word to me, experience, means you've done it.
And what does that mean?
You've experienced bad stuff.
Okay.
You've actually been in the market.
In the market,
you've
when
experienced
it's gone down.
the problems.
Okay.
Yeah,
makes sense.
I believe I need to take greater risks to meet my financial goals.
That's an interesting question. Yeah, that's fascinating.
It is.
Yeah.
It's a great question.
Yep. Mm-hmm.
Because here, this question is saying, this determines your need for risk.
Thank you.
Not your tolerance thereof, but your need for it. Do you need to take greater risk to meet your goals? Maybe your goals are low and you don't. So I'm going to say I somewhat disagree with that.
And I think
'cause I don't.
That point is probably the most important when it comes to investing, because most people do not know what rate of return they need to either save up enough for retirement, or if they're in retirement, how much money they need to make to sustain their lives for the rest of their lives. That's a number you need to know, but they don't, sadly.
And now we're going to get to where the rubber really meets the risk road. I am more concerned with maximizing returns than minimizing losses.
We know most of you are going to err on the side of minimizing loss. Survey after survey shows people would rather make less but see their portfolio go down less in tough times. It's pretty clear. So most people are going to say they'll take less.
And here's another one that is a critical question. Answer this one honestly. If my investments fall in value during the first 2 years, I would sell them immediately, wait 1 to 3 years, wait 4 or more years.
Wow.
See, now I know enough because I'm an experienced investor to know that you might even have to wait 4 or more years. There have been a couple of times when you did.
Gene Fama once famously said any return under 10 years is noise. So, and he won a Nobel Prize, so kind of respect his opinion about money.
And then they get into some really complicated ones. I'll just show you the screenshot of this one, but we're not going to get into this in great detail. It kind of shows you a spread. If you invest $100,000 for a year, and what you get to do is pick between 3 different possible outcomes: a high of $100,000 going up to 104 or down to 100, back down to 100, going up to 110 or down to 96, or potentially going to 121 or down to 85. So you have to pick which one of those is best for you. Again, this is sort of saying how much volatility can you stand? They keep trying to get to this over and over and over again in different ways. How much volatility can you stand? In 2008, international stock markets dropped approximately 44%. This meant that $100,000 invested at the beginning of 2008 would have been worth $56,000 at the end of 2008. However, in 2009, world stock markets rose 36%, meaning that $100,000 invested at the beginning of 2009 would have been worth $136,000. To what extent do you agree with the statement? I'm comfortable with this kind of volatility. They ask it over and over again.
That's such a fascinating word, comfortable. I mean, I don't even know if I'm comfortable with it, but I accept it because I know that that's led to higher returns.
Another one, and again, they're all trying to get the same kind of information in just a different way. It is possible for some investments to undergo long periods of underperformance. For example, the average return for the entire U.S. stock market between 2001 and 2010 was approximately 2.2%, including dividends.
Which all came from
10 years. That's the lost decade.
Stocks, by the way, because large actually underwater for that period of time.
The average annual return for the U.S. stock market between 1950 and 2000, however, was approximately 14.4%.
Wow.
Are you willing to maintain your investments during long periods of underperformance? Different way of asking the question. You can see how fascinating this is in the way it digs into your head and makes you answer questions differently. And then it does the math and says, okay, this is where you are.
Okay, but
I am comfortable investing in a new business. Oh, go ahead.
No,
I'm sorry.
Okay,
Tom.
I was going to say, I thought you were at the conclusion. Comfortable investing in what, a new business? Is that the question?
Yeah, this is the next one. I'm comfortable investing in a new business.
Wow. I mean, I don't know that I
am.
I mean,
today my answer's different.
Yeah, than it would have been 10, maybe 15 years ago. I mean, we started Vestry.
Yeah, today my answer
15.
is different.
Yeah, so, but you've pointed all this out very well. I guess the question I have at hand is, okay, I go through this and I have a score of, and I think my score was 87 or something. I didn't get 100. We've had a few people in the 90s, but not many. I mean, it takes a pretty hearty soul to say, yeah, I'm okay with all. Yes. It's hard. But let's assume your score was 80. Does that mean you should be in a portfolio that is 80% in stocks and 20% in fixed income?
Funny you should ask. Funny you should ask. I scored a 74. I just finished it.
Really?
You get a nice report. Yeah, you get a nice report. I got a 74 out of a possible 100, which puts me in risk tolerance group 5. That's people who have a high risk tolerance. And that number, and if you scroll down, it below the charts, it says connecting your score to a portfolio. There, it's right here in the report. Right here. Here you go. Right there.
Just like one of those dating services, it's going to connect you to the ones that are like you.
I scored 74 based on your risk tolerance. The matching portfolio is 80% global equities and 20% intermediate U.S. bonds.
Which is higher than you have. You need to be selling those fixed incomes and buying the bonds.
You see, what it says is I have the tolerance for it, but I don't need to do it.
Thank you. Thank you. This is exactly what I was saying 3-4 minutes ago. Is again, if you know that your plan works, if you have a plan, if you know that your plan works only making 5% a year, why in the world would you have a more aggressive portfolio that should make more but exposes you to greater volatility? So, and by the way, that greater volatility leads people to make horrible decisions. We're seeing people sell all kinds of stuff. We're seeing people buy all kinds of annuities, other crap, pardon the expression, because they're nervous about the future. So thank you, Don, for pointing that out, because I think that's absolutely critical. You need to know those numbers, how much you need to make, how fast you need to drive down the road. I equate it to driving because people go by me at 80 all the time, and I'm going 65, and I think I'll get there on time. I want to go as fast as that guy because that's cool, but I don't need to. So thank you for pointing that out. Once you have that number, you can tune out all of the noise, and the noise is loud and always getting louder, if you ask me.
Absolutely. And that's why I wanted to do a little walkthrough of this, because I think a lot of people are kind of afraid to take this thing because, well, one, it's hard to answer some of these questions honestly. 2, it's tough to know yourself. 3, it's tough to find out you've been doing everything wrong, but it's great to find out if you've been doing it right. And you know, at the end of the day, isn't it better to know what you should be doing? At least get a clue as to what you should be doing? I think everybody should take this thing. I love it. We put it up for free a long time ago. We could have been charging for it. We probably, I mean, if we were smart, we would have been charging for it, but we're not smart. We're not that smart. But it's free, and it's easy, and the addresses are on the screen. You just click on or just go to one of those websites and get the RisQuiz and then fill the darn thing out. If you have any questions, you can call us. We'll try to help you understand it. We'd love to do that. But the fact of the matter is, if you know this, you can build a portfolio that isn't going to put you into bear markets. You will not have a personal bear market if you do this right.
Thank you. I feel so much better. Without the electrodes,
Do you?
It's still okay.
Oh, my gosh. We almost went to 30 minutes on that one. Well, we better end this podcast.
No questions?
No, I think this is very helpful. Risk is important. One of the most important things you can know is your risk need, risk tolerance. We call it your risk profile. Because without that, you cannot make smart decisions. You can't.
No, you'll make bad decisions.
Anything else?
I think you'll make bad decisions. Again, if you have a plan, if you know this, by the way, if you take the test and you know that you score a 30, for example, you know you're risk adverse, but you know you need to take a little more risk, you can sometimes talk to yourself and say, yeah, I know this is the makeup, but I also know that my financial future won't work unless I'm exposed to stocks. You talk yourself through it.
And you want to hear a really stupid idea
Yes.
to help you? It really is a great stupid idea. Is you write yourself a Post-it note that says, while I understand my risk tolerance is low, I have committed to taking a little bit more to enjoy the future I really need. So don't panic, and Put that inside your medicine cabinet. Put it somewhere where you see it every damn day.
I think that's great. By the way, before we let you go, what did you settle on the birthday? Are you going to do something outdoors or not? People want to know.
Not if I have anything to say about it.
Okay. Because you can't count that high or just because of the weather?
No, because I don't want to go out in that.
I see. Okay. All right.
I mean, that is just... Do you know how hot it is 98 with like 75% humidity?
I don't do well in that at all. So while I complain about our weather here,
No.
I
honestly, if I had my way, I would be in Virginia right now.
Let's not go there.
Carry me back to old Virginia.
With my banjo on my knee. No.
I am not even going to sing the rest of that racist song. That's the only part I'm singing.
All right, good for you. I think that's probably a good idea.
All right. Thank you. It is so racist.
Yes, it is.
Thank you all for being a part of our little get-together. And bear in mind, though, that stupid song was written pre-Civil War, so people were stupid. Thank you all for being a part of the little program, and please go out and take the RisQuiz at Vestry or TalkingRealMoney.com. And if you need a lot of help, we'll give you a lot of help. You can either pay us for it, which a lot of people do, or you can get some for free, more than you would imagine for free, by going to Vestry.com and setting up an appointment with one of our advisors, Vestry.com.
I've been doing a lot of these Saturday calls already. I've been loving it.
He has been doing Saturday calls with people.
Go ahead. Set them up.
You can set up a Saturday call with Tom. Just go to Vestry.com. Put a little note in there and say, I want Tom.
Which
you don't really want Tom, but
we'll take it.
You understand what I'm saying. You done now?
I'm done. Thanks for...
Are you done?
Doing all this.
Okay, then.
Great.
Go do whatever it is you're going to do for the rest of the day. I'm done. That's Tom.
Peace.
We're talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?